So we were just on this slide in the previous recording, and we were talking about how good is this measure. There are costs to carrying current assets, so healthcare organizations have to balance the need for liquidity against the associated costs of maintaining liquidity, meaning that if you invest in highly liquid, low risk investments, you will make less cash when you sell them because their interest rate is usually not high. Um, Net patient accounts receivable is the amount that is already a part of the net patient service revenue. And so, of the $169 million reported in patient service revenue in 2020, 28, approximately $28 million are the receivables that are yet to be collected. So where is the balance? Where is the 169 million minus 28 million, 141 million that has been collected? And so this amount is already a part of the net patient service revenue because it has been collected, and that becomes the net patient service revenue that you have earned as a part of your operating income. Inventories show the dollar amount of expendable supplies on hand. So for providers, inventories can be medical supplies and only the amount that you expend. So if you buy a box of 100 gloves and you have used only 10 of them, then you can expense only 10 of those gloves. You cannot expense the entire 100. So providers with small inventory balances often show them in a catch-all other current assets account. If they don't have a high balance of inventory, they will just show it as a other current assets account. So note that current assets are listed in order of liquidity or how near they are to cash. So cash and cash equivalents are the most near to cash. Then there is short-term investments. Then there is net patient accounts receivable, and then there is inventories. Um, Current assets are necessary to support operations, but they provide either no or little explicit monetary return. They are definitely very important to support operations, but as far as selling them and making money, that's not very much possible. Like nobody's gonna go sell their MRI machine to start making money. They will do something else to make money. So should businesses hold large amounts of current assets? Then that's the next question. So no, because businesses should have a certain level of supplies that are necessary to meet medical needs and maintain a safety stock guard against unexpected surges in use. For example, COVID. But too much, if you start hoarding too much, then that can cause unnecessary expense on you and create unnecessary cost, which will ultimately lower your profitability. Long-term investments are investments in securities like financial assets as opposed to buildings and equipment, like real assets or real estate that have maturities greater than 1 year. Sometimes this account is referred to as funded depreciation. It is used more by not-for-profit businesses than by investor-owned businesses. And why is that so? Yes, it is used by not-for-profit business organizations because for them it is a savings account that ultimately will be used to purchase buildings and equipment. For investor-owned places or hospitals, any cash flow in excess of the amount needed for um, reinvestment is likely returned to the capital suppliers, example, creditors and stockholders. Net property and equipment represents real assets as opposed to financial assets having useful lives greater than 1 year, and often these are known as fixed assets. In general, the assets reported on this line consist of land, buildings, and equipment. Although only a net amount is reported on the face of the balance sheet, the note section contains the gross or the net breakdown. So here's a slide that shows how the property and equipment are listed. The property and equipment here is broken down into land, buildings and equipment, gross property and equipment, less, and you remove the depreciation from there, and then that gives you the net property and equipment. Fixed assets are posted on the balance sheet at their original cost, and then for each year the accumulated depreciation is increased by the amount of depreciation reported on the income statement. Thus, the net property and equipment amount is reduced each year by the annual depreciation expenses. So Sunnyvale Clinic has liabilities and equity also, and this is showing current liabilities, which shows notes payable, accounts payable, and accrued expenses, and then that gives you the total current liabilities. Long-term debt, and then total liabilities is basically $85,000 plus $15,000, which gives you approximately $100,000 for 2020, and then you also have the number for 2019 for total liabilities. And then you have the net assets, which is the equity for 2020, which is approximately $54,000. So you have a total liabilities and equity of $154,000 for 2020 for Sunnyfield Clinic. Liabilities represent claims against assets that are fixed by contract. So those are claims that which is the assets that you own it against. If you get the liability, if you're getting the loan, then you're getting it against some asset. So these are the liabilities, which are claims that represents that are claims against assets and are fixed by contract. You get a loan for 30 years or 15 years against your assets. In other words, liabilities are fixed financial obligations of the business. Failure to meet these claims can result in bankruptcy and potential closure. Although some liability obligations are to suppliers, employees, tax authorities, and vendors, the largest obligations are to creditors who furnish debt capital to businesses. So creditors, they furnish debt. I mean, they give you the debt to buy more assets. And so some obligations of liability are to suppliers and employees, but the most obligation lies in the hands of the creditors. So current liabilities are those obligations that come due within 1 year of accounting period. And the most common current liabilities are notes payable, if you have any notes that you need to pay, like treasury notes, if you have any accounts that you need to pay, and if you have any accrued expenses that you need to pay off. So notes payable are short-term debt obligations, and they are typically bank loans. These are maturities of less than 1 year. They often take the form of a line of credit. They usually used to finance temporary increases in current assets. An example of notes payable is, let's say, a walk-in clinic builds up its inventories of medical supplies, but when the season is over, the supplies they come back to the lower level, and this temporary increase is funded by a bank loan of some type, and that is notes payable. Accounts payable stems from buying goods, which are typically medical supplies, from vendors on credit that are called trade credit. Vendors often have payment terms such as net 30. Here the provider has 30 days to pay the invoice. The amount is purchased but not yet paid, and it is carried as an accounts payable. So how much trade credit should be used? And that is a question that you can think about. Should we have a trade credit of 30 days or 60 days, or what should it be? And those are payment terms that the vendors decide. Long-term debt represents debt financing with maturities that are greater than 1 year, not less than 1 year. And smaller businesses often obtain long-term credit from commercial banks, and that debt is called as a term loan. And larger businesses typically issue or sell bonds. And there is an exhibit on page 131, and that's exhibit 4.3. So page 131, 4.3, and that is something that you should definitely look at. So there is a loan payment repayment schedule for year 1, year 2, and year 3. There is interest on loan, and there is principal, and then there is the total payment, and that is kind of a bank loan with 3-year maturity, and that is a long-term debt. That is a very good example of long-term debt. And equity, net assets, represents the non-liability claims against a business's assets. Equity obligations are not fixed by contract, so there is no contract that is setting the equity obligation in stone. For investor-owned businesses, equity is the amount of owner-supplied financing, and for not-for-profit businesses, equity is the amount of capital that is supplied by the community. So when it is a not-for-profit business, they solicit contributions, they solicit endowments and donations, and that is coming from the community. But for the investor-owned businesses, all of that is coming from the stakeholder, from the shareholders, right? So as mentioned earlier, the equity account is basically a residual. So you minus your liabilities from your assets, and that gives you the equity account. Net assets present the dollar value of assets remaining after subtracting business liabilities. The equity section of the balance sheet is basically distinguishes an investor-owned business from a not-for-profit business. A not-for-profit corporation's equity account is called net assets. It is the dollar value of assets net of liabilities. So you have to make sure that you understand that the not-for-profit corporation, the equity account is basically called net assets, and for-profit, that is not true. A for-profit section might look like this. There is stockholders' equity, which is not true in the case of not-for-profit organization. So the title stockholders' equity represents that stockholders own the business, and they have common stock and retained earnings. $9,000 was collected by selling common stock to shareholders, and retained earnings represent the accumulation of earnings over time that are reinvested in the business. Retained earnings are not readily available to buy new equipment or to pay dividends or for any other purpose. Okay, that's what these numbers mean. When you add those two, you get the total equity. So note that retained earnings account, the entire net equity account for not-for-profit organizations, is affected by the amount of net income shown on the income statement. For a not-for-profit business, the entire amount of net income flows to the equity section of the balance sheet. Okay. Remember, we talked about statement of equity in when we are talking about the income statement chapter. And then for-profit business, some of the net income may be paid out as dividends, and then whatever is remaining after paying out the dividends flows to the balance sheet. And that is how the statement of equity for the for-profit looks like. And this relationship is detailed in the statement of changes in equity. The right side of the balance sheet gives the business's mix of debt and equity financing, and that is called the capital structure. Capital structure is a key financing decision because it affects a business's overall risk and cost of financing. So Sunnyvale's balance sheet reported about $54 million in equity for 2020. One of the physicians has proposed that the equity be tapped or used to build a new clinic on the north side of town. And that is, so basically the question is $54 million available for this purpose? Now it is a retained earning, and if you have to claim it against assets, it may not be necessarily available. This money may have not only been used to, this money may have only been used to fund something else, or it may be in a long-term investment account. Only the portion that is sitting in cash is available to the business for use, so it may not be available readily for use.